Super. So I think I will begin. Hello, everyone, and welcome. Thank you for joining us today for this open forum hosted by GBM. We're very pleased to have with us for what we expect to be a timely and an insightful conversation on the evolution of digital financial services in Mexico. Today's session features KLAR, one of the most dynamic fintech platforms in the country, and we're honored to be joined by Stefan Moller, CEO and founder of KLAR. Before launching KLAR in 2019, Stefan built a strong foundation in strategy and venture development, beginning his career at Bain & Company, and later joining Nova Founders Capital. Since founding KLAR, Stefan has led the company's transformation from a challenger credit startup into a full-service digital financial platform, driving rapid growth and product expansion. KLAR has the mission of democratizing financial services in Mexico and has grown rapidly in a relatively short period of time. Today, the platform reaches approximately 2.6 million monthly active users, according to SimilarWeb. As of the third quarter of 2025, KLAR reported a 6.5 billion peso loan portfolio and an 8.3 billion pesos in deposits, positioning it as the fourth largest fintech in Mexico by loan portfolio. More recently, importantly to add, KLAR announced the acquisition of Banorte's digital bank, Bineo, a strategically important step that provides KLAR with a banking license and significantly expands its ability to broaden product offerings and accelerate growth across the ecosystem. During today's discussion, we look forward very much to hearing more about KLAR's strategy, recent developments, and their outlook for the business and the broader fintech landscape in Mexico. With that, let me turn it over to our speakers, beginning with our GBM banks analyst, Pablo Ordóñez. Over to you, Pablo.
Thanks, Nikki. Thank you very much. Thank you, Stefan, for being with us. It's a pleasure. It's an honor. So let's make this a very dynamic conversation. And thanks everybody on the webinar. Please send us as much as any question that you like. We will add this into the conversation. So let's start the conversation. I think Stefan. Here in GBM, our investment thesis for the industry is that we are in one of the most important times for the banking industry in Mexico. I think that from the last 30 years, and you have been a key player here. So I think that it will be very interesting to hear from you. I think that we can start with a recap of the past 2 years. I think that 2025 was a key year for the ecosystem as a whole. We have the central bank cutting rates, and I think that you and the rest of the industry consolidated in terms of traffic, in terms of the deposit franchise. So what were the key milestones and the key trends that we observed that happened for KLAR in the past 2 years, Stefan?
Yeah, absolutely. Thank you so much, Pablo, and also Nikki for the kind introduction, and thank you for all the attendees. I was put up against the Trump speech, so the fact that we have a decent quorum here is very much appreciated. Yeah, I mean, I think you folks summed it up fairly well. I think that the last couple of years have been indeed the years of consolidation, right? I think particularly for local analysts such as GBM, who have followed this since the 5-6 years of the fintech boom, right? I think maybe there was a little bit too much capital and too spread out capital, and now it's all consolidating into a couple of theses that also seem to be more bundled. I think that that's also a key piece, right? I think not just Mexico, but globally, there was this notion of, hey, maybe this is the unbundling of banks, right? And there's going to be space for a lot of niche players that get venture funded, or it is the rebundle, but in a digital way, right? And I think we always bet on the strategy or the story to go to the left, right? Like the rebundling per digital. And I think that that's what you're also seeing, right? So what I'm trying to get at is you see 4 or 5 players, right? Well capitalized with a fairly broad product suite, competing for principality and not just like ancillary relationships with the users. And that is what the last 2 years have given us, right? It took a little bit longer than we expected, to be very candid, right? Like there was still a lot of money pouring into niche use cases, but now it seems to go into the rebundled regulated, well-capitalized, broad product suite players such as KLAR, right? So I think that that's exactly what you described. I think for us, it's been a couple of years of also like more comfort managing the loan book, more comfort with the risk models, more comfort with the product capabilities, right? I think this is a game in which there are no shortcuts, right? Like we've seen it with the very large publicly traded companies. If the book grows too quickly, it stagnates at some point, right? Given that the learnings start to come in and then the policies, the models need to be adjusted. We've taken it a little bit slower, launching 5 years ago, the first 3 years, tweaking, understanding, getting comfort around certain levers that we can pull to manage the loan book, and then scaling more rapidly, right? So I think that has been the biggest win here, right? Like we come from back-to-back years of growing close to 100%, in terms of top line, in terms of gross profit, growing materially higher than that. And that has put us in a place in which the business self-sustains, right? Like the business doesn't need additional capital from external parties in order to continue growing, right? Given that we can make the business break even. The business has a ton of cash in the bank, right? And so this is a place where we then continue doubling down on expansion. And after a 90% year-over-year growth top line, 3x gross profit expansion, we look at another year that will end up in similar ranges, but from a much broader base, right? So this is a year not just of consolidation, but also of scale, right? Where you continue compounding with a lot of certainty on a business that is already at scale, and that opens up different avenues. For example, an IPO in which scale like still is a very high threshold, margin is there, so we start to check a lot of the boxes. So that's one. I think the other one that is important, and I think I try to touch on it, right, is this multi-segment, multi-platform approach to banking, right, which is a bit of a different story than what we've seen in Brazil. We always believed that would be the story of Mexico, who can serve different segments with different products, who can then swap over onto the SME side, maybe a bit of corporate, reap the benefits that the banks are so good at reaping between those segments by cross-selling, and I think we believe that that's the real key to Principality, right? More products, more angles to the same platform, and hence being able to command Principality in which is what is still a competitive market, right? Like that has always been our thinking. And I think last year, given that the consumer business was in a very good place, it has allowed us to expand and deploy product capabilities, product resources. We also made an acquisition of a B2B Fintech in which we bought a lot of data, a lot of underwriting data that made us feel more comfortable scaling at a higher speed. And so the loan book on the B2B side is still small, but growing $5-6 million month over month, right? So we feel very comfortable attacking that multi-sided approach to the platform. And we believe that will be one of the key deciders of who wins the race to an IPO or who has interesting exit avenues, right? Not just a mono-line, mono-segment, mono-product company, but building a multi-platform, multi-sided platform that happens to be built digitally and has all the advantages of being built digitally, right? So we saw that, and it's now coming to fruition, and we're pretty excited about it.
Great, Stefan. So that was a great recap. Thank you. Maybe we can jump into each side of the product and the balance sheet here from our side, and also in the interest of those who don't know KLAR as well. Who is KLAR in terms of its funding strategy, the clients that you're addressing on the on the credit side? Sorry, because I mean you have like a broad strategy attending like middle income consumers, but also you have a high profile platinum credit card. We have been here testing several of the products now. So how do you think you will play the deposit war? We started with a deposit war a couple of years ago, which now has consolidated. And where do you see these markets on the two sides of the balance sheet in the coming years, and how will KLAR differentiate in terms of your product strategy and the users that you are addressing, Stefan?
Absolutely, right. So I mean, on the first side of the balance sheet, right? This is a market, and I mean, you talked about like the most pivotal moment for banks in the last 30 years, right? We believe it goes beyond it because you have a market in which 50-60% of the G7, right, or the big banks that control 80-90% of market share stems from deposits, right? They pay zero, they earn 8, 9, 7, like couple of years, maybe 12. And you start to see a bit of complacency, right? If 50-60% of the business comes from that side of the balance sheet, then there's going to be little appetite to go out and lend, right? And just to put a comparison to that, in Brazil, Itaú, which is the biggest deposit taker, pays 0% on about 9% of their deposits. In Mexico, BBVA, the deposit leader, pays 0% on 89% of their deposits, right? So it's a different ballgame, right? It's one, like everyone thought Brazil was the most complacent banking market because of lack of competition. It turns out that Mexico realistically is the most complacent banking market, right? So you start to see that equation shift on both sides of the balance sheet, right? You talk about the deposit war. Indeed, because of the cost structure that we have, right? We have a cost to serve of 60 cents, maybe 70 cents on a bad month over our active user base. That figure is not public for banks, but that figure must be in the $2-3 on a monthly basis per bank, right? So our cost to serve is world-class, best in class at global levels, better than Nubank in Brazil, better than banks with a lot of scale. And that then allows us to lose money on that line of the P&L. No, not anymore, right? But then to go out and reward the users and say like, hey, whatever I make on your deposits, I will give back to you, and I will figure life out and figure out how to make money on the lending side or on a different product, right? And I think that that's what competitive banking structures, banking market structures actually end up showing, right? If you look at Brazil, if you look at the US, etc., the money needs to be on the lending, right? It cannot be on the deposits because that's not a sustainable model. So we saw that happen, right? In which indeed maybe 2 years ago already a bit of a deposit war started, right? Where we all started answering one of the most structural questions in fintech, right? Is like, are there enough deposits willing to go to fintechs? For me, that was one of the few binary risks of the market where we say like, hey, if Nubank and Pago and KLAR are all fighting for $1 billion in deposits, there's not going to be enough in order for us to finance our books with our own funding, right? The answer was expensive, but it was the one we wanted to hear, right? Like definitely there are enough deposits willing to flock from the G7, from the big incumbent banks into fintechs, okay? The other thing that we've seen answer, and maybe more so on in the last 6 months, is there's stickiness to 80% of those deposits, right? Like so the first question was answered with a big yes, because we're sitting on $500 million of deposits. Nubank is sitting on an absurd amount of deposits. Even Story is sitting on a good amount of deposits. So everyone got the deposits that they want. Then the question was, are all of those deposits ultra efficient and they will flock to whomever is offering the highest rate, right?
Yeah.
And luckily enough, the answer was also answered positively for us because I think Nubank pursued a strategy of trying to suck the oxygen out of the room, being the best funded player, by which they were then able to pay a negative spread on deposits for 9 months or like longer than any of us could hold. But it wasn't like all of the deposits flocked to Nubank, right? Like maybe 50% of our deposits, when we pulled the brake, we started paying what we made on those deposits. Our cost of funding went from 13 to now 7.5, right? I mean, unfortunately, Banxico keeps cutting, right? But assuming that it plateaus, we will be at net neutral carry territory, which is where we want to be. Yes, Nubank continued taking deposits. They were expensive deposits, but they didn't they didn't take all of our deposits. They didn't take everyone's deposits, right? So there were two structural questions that needed to be answered on that side of the balance sheet by the deposit war. And honestly, for me, it was a coin toss, right? Like maybe there weren't enough deposits. And maybe the market was so efficient that the deposits would always go to whoever is paying the highest rate. Luckily for us, both answers were answered favorably, in which there are enough deposits, and not all deposits are as efficient that they will always flock, right? So that has allowed us to manage our deposit base like with a precision, with a millimetric precision, right? We go to our assets and liabilities committee, and we say, hey, this is where we believe the loan to deposit ratio should be based on what we're seeing in the market, based on the duration of the loan book, based on the duration of the deposits. We get a green light and we match exactly, we take in as many deposits as we need, and then we close the key, las llaves again, right? So that's a little bit of how we think about it, but it's a good place to manage a balance sheet from that side of the equation. Now, on the other side of the equation, on the lending, I think one of the questions that was obviously going to come up because of the deposit war was, hey, are these users literally just coming for the rate, or are you able to build a multi-product relationship with them, and maybe ideally a principal relationship with them, because we all know that principality goes through multi-product relationships, right? And so what we saw there is what was expected. You start to get very premium users, prime, super prime users from an underwriting perspective that we're not used to seeing. And they're very easy to underwrite, but they're very hard to convert because everyone gets approved, right? Because this is a segment that is bankerized, that is well served by banks, that has experience with credit cards. But they don't want your credit card, right? Because the limit is too low, the rewards program is not at par with an existing credit card, etc., right? So we launched a platinum credit card, an affluent segment credit card, month 3 of the deposit war, right? Because we didn't just want the users for their deposits, we wanted their relationships, right? And so you start to see the conversion within those income deciles, like the conversion to active users used to be at maybe 5%. No, with our standard credit card, it goes all the way up to 60%, right? And it turns out that those users that have more than one product with us retain 2-3 times better than the rest, right? Because they say like, hey, even if these guys are offering a slightly higher rate, I like KLAR, I have a credit card there, maybe I have a personal loan, I have my deposits there, it's not worth the hassle for 100 bips per year, okay? And so that's the other question that in our eyes was obvious would arise from the deposit war. And it comes down to product capabilities and to product velocity, because it was very surprising to us that we were the only ones to launch a premium product within that deposit war, right? Like the reality of that deposit war is that the deposits are coming from high income individuals that don't want the fintechs credit products that are more geared towards the middle class and the middle lower class and the bottom of the pyramid, right? So it then goes to the existential question that always has driven a lot of our thinking. This isn't a monoline, mono-segment, IPOs crazy story. This is a little bit more of a bank-like story, right? To say like, hey, these segments I serve with this product, these segments I serve with this product, and I figure out how to find a virtuous cycle between all of them, right? And I think that that is starting to distinguish the different capabilities that the companies have, right? Because some of them seem to be stuck on one approach, and some of us, like us, that move faster, have world-class talent on the business, on the engineering, on the credit side, we move relatively quickly to adapt to these changing market environments. And I think that that has also been a key over the past year. No? So where does that leave us? With a multi-tiered offering on the credit side, right? Both secured credit cards that goes from folks that we cannot say yes to. No, we have maybe 400,000 or 500,000 of those, probably one of the largest secured card portfolios in Mexico. Then we have our core product, which is middle class. It serves those income deciles, the 5th, the 6th, the 7th, which are our core deciles. But we also have a growing and a very healthy affluent credit card portfolio, right? Which serves the 10th decile, the 9th, and the 8th very effectively, right? And we believe that that's where it needs to go, right? I think this story of people want my card because the color is super disruptive it worked in some places. It's not going to work in Mexico, and we never believed that it would, right? So that has made us put our money where our mouth is, where we say, hey, we are the best at technology, we are the best at product, we are the fastest, and it needs to be reflected in the product strategy and in the products that are out there. Okay.
Great, super interesting. Yeah, maybe that's exactly our reading from this side of the trenches on KLAR, a multi-tier product offering. Can we dive further into on the deposit dynamics? So do you think, because at the end of the day, one of the also key milestones that you reached, Stefan, in 2025 was taking care of profitability, no? So how do you, and you mentioned that the deposit market is there and that Nubank had enough deposits, but if you look into the, as you mentioned, into the incumbent banks, they are sitting on commercial on retail deposits of more than $200 billion, no? So and it has been like very interesting for us to see that at the end of the day, for commercial banks, the cost of funding has been actually improving, no? So my question is, do you think that if you want to go further, can you gain more deposits, and that you're waiting to gain more deposits just to have the other side of the balance sheet, the credit side, like to reach a profitability first? Because the other thing that is a key question for us, and we would love to hear your insight, is when and how do you think that on the asset side, the business is going to be profitable? Because we continue to see, I mean, you're very close to profitability, no, in the third quarter, but the cost of risk continues to be a challenge. No, of course, we are still in an early stage for the fintechs, but how do you see the dynamics and the future for the profitability also on the credit side? And where do you see the deposit dynamics for the fintechs and for the banks in the future? Do you think that you can stand paying 100% level of interest rates for the next 5 years? So how do you see these two dynamics in the coming years?
Yeah, I think that the deposit side is relatively straightforward. And I would say that what is so encouraging about the sector is precisely the dynamic that we observe on the incumbent side, right? It is not that they are running out of deposits, that they are doing a crazy decision that they've been avoiding to do for 100 years, which is not pay zero. Because that would mean that the competitive dynamics and the profit pool and revenue pool shift is at a somewhat advanced stage, right? Which is like, hey, we're starting to take a meaningful share of their deposits and they need to react. We seem to be very far from it, right? And I'd rather be in that place because that then shows, hey, there seems to be enough runway on the deposit side for the 3-4 competitors, even at scale, right? And so that for me is very encouraging, and one of the reasons as to why we're so bullish. As we all know, Mexico moves incredibly slow in everything that is fintech adoption. I don't necessarily know why, right? I think there's many factors such as cash dependency, maybe a bit of reluctance or complacency from the authorities to hit the G7 a little bit harder. Maybe it's the Mexican risk aversion, I don't know. But it will happen, right? One of the questions, and I don't have an answer, is does it happen linearly, right? And this is a game where 15 years from now, Banorte starts to see that their deposits are in a place where they don't want them to be. Is it 5 years from now, or is it exponential, right? And it happens in 2 years, like it happened in Brazil with the introduction of Pix, right? Like it might happen with some of the initiatives that Banxico is pushing in terms of digital payments, right? I don't know. All of them work for us because the real answer is that the deposit pool is still 98% on the incumbent side. And we have built up meaningful reserves on the deposit side to grow the business to the tune and to the profitability that we need to grow it, right? So overall, that question for us was a very top of mind question throughout the last 2 years. Now we look at the indicators, but strategically, structurally, we feel as comfortable as we could feel that there's going to be enough, okay, and at the right price. Now, on the lending side, it is true, right? I think the reality, though, is that the cost of risk, if you look at our IMOR, like which is the one that gets replayed by the regulators, It's today at 11%, right? If you look at Story, I think it's 14%. Maybe some of these figures. No, these figures must be public because I have the competitors, right? So we're 11, Story is 14. Nubank has done a very good job, no? And they're now at 8, right? Like, I think they've managed to bring it to a level in which things are very, like, scalable, right? And props to them. But if you look at Bancoppel, it's the same, probably higher than us, right? If you look at Banco Azteca, it's probably higher than us. If you look at BBVA, who happens to have a business in which they only lend to the like crop of the crop, or if you look at HSBC, who literally only lends to people that have their payroll at HSBC, right? We're going to look higher, but the reality of the market is this is a credit market in which banks only serve 20% of the adult population, and that is not what an efficient lending market should be. If you compared us to the SOFOMs and the informal lenders that are filling this void, because it's not like Mexicans don't like lending, right? Like they're getting their lending, but they're getting it from a different channel than an incumbent bank that continues to say no, then we look like the most effective and efficient lenders on earth, right? Like that is the reality. It's a different segment. It's hard to compare against the banks. And we also charge on those segments a higher interest rates that, despite the higher cost of risk, makes the unit economics pristine. This is a high yielding portfolio that allows us to break even on a monthly basis, right? So it's, would I prefer for the rates to be lower and the cost of risk to be lower? Yes, frankly, right? Even though the unit economics will look the same. But that's where the market also needs education. The market needs further penetration, etc. Right? So that's that. If you look at our premium product, it performs the way that Banamex credit cards perform, right? Or maybe slightly better even in terms of cost of risk, because we are underwriting a segment that Banamex underwrites, right? So I think this is a bit of a biased view about that stems from a baseline from one of the least credit penetrated markets on earth, right? And I think as the premium part of the portfolio becomes a little bit higher, we're going to start to look a little bit more like that, right? But it's a product that works. Would I like the rates to be a little bit higher on both ends of the equation? Yes, but I think that that's also a place where the industry needs to get to, okay? So I think the cost of risk, that part of the equation, is where we want it to be. One thing that we've seen, and that has also driven some of these public metrics to places where we didn't love in like over Q3, so to say. One thing that I think the industry is overestimating, and that is a reality, and we overestimated it as well, is the capacity, or we're underestimating the second order risk within our platforms, right? Where we say like, hey, we give you a credit card of 7,000 pesos, no? You pay. We increase the line to 10,000 pesos, you pay. We give you a personal loan on top of it of 20,000 pesos at a lower rate, boom, and we start to see a spiral that gets a little bit out of control, and they cannot repay the loan, they cannot repay the credit card, they cannot repay everything. One of the questions that needs to be answered, and very candidly, I don't think the industry will love that answer, is that the capacity of repayment within the same platforms is a little bit lower than we had budgeted, right? And that then means that we need to look for more users instead of to the same user just continue to give additional credit, right? So that is where we've seen a couple of surprises that we didn't love, if that makes any sense, okay? I think, and when it comes to users, and I think like very candidly, and as you also described very well in your reports and probably as part of this series of forums, the competitive dynamic is maybe a little bit still more intense than we would have predicted, right? Like you still see new entrants with significant funding from somewhat controversial sources, but it continues to flow in, right? The consolidation maybe hasn't been as aggressive as people expected it to be. And so and then you have the two titans of LATAM, no? Nubank and Mercado Pago, spending incredible amounts of money to continue acquiring users, right? Like, I mean, there is no virality in the products, right? Like, there is a certain degree of commoditization between the products is the reality. And so who gets more users is whoever is willing to pay the most for them. Like, that's a reality, right? And when you're competing against folks that have an $80 billion market cap, and maybe Mexico accounts for a fourth of that valuation in one way or another, then it's like, hey, if Nubank spends $5 billion in Mexico to build a $3 billion business, the markets are not as efficient as to punish them, right? Maybe it makes sense. If you have the Russian gentleman like spending $1 billion to build $1 billion business, maybe they have the reasons to do it, right? I mean, they want to make it worth $3 billion. Let's see if the markets bite or not, right? But it is a market in which what we thought would be rationality kick in at scale hasn't kicked in at scale, right? And that leaves players like Story and KLAR that are venture backed with governance, right? Where we need to go and explain why we're acquiring users that we know we're not going to make any money on, right? Or it's going to take us 50 months to pay back, why we're doing it, right? So that is something that I wouldn't have expected to see in the market, right? Now, what we're doing to address that is, I think 2026 is the year of distribution, right? I think everything else is in place, scale, deposit wars, cost of risk, let's bring it down to 100 bips, but we'll get there. I think 2026 becomes a question of distribution, right? In a market in which you have such undisciplined, somewhat irrational spenders, what is it that we can find in terms of proprietary distribution, right? And so, for example, I like spend a good amount of time, 25, negotiating a deal that will go live. Let's see, I would expect it to go live beginning of Q2. They're probably going to be the largest co-brand program in Mexico, right?
Yeah.
Why are we doing it? Because we need to find proprietary distribution. We need to tailor the benefits of the products to the certain user cohorts, because in a market in which the products get somewhat commoditized, nobody cares if the card is purple or orange or green, realistically speaking, right? Like, that is also a reality. Maybe from that side of the trenches, it looks that way. It looks this way from this side of the trenches as well, right? So distribution will be key. Who can find proprietary distribution? We are working on that one. That is a done deal. We're working on a couple of other programs at an earlier stage in which we believe distribution will become the key factor of 2026. And these are deals that take time, right? So if you didn't work on it 25, 24, it's probably not going to come to fruition in 2026, right? So that is the part of the market that is a little bit more frustrating, right? To compete against such irrational capital, right? And irrational, maybe it's not even irrational, it's undisciplined. But if Nubank can justify $20 billion of enterprise value and doesn't trade like Itaú because they are in Mexico and they have a decent success story to show, that's amazing, man. It's the smartest move on earth, right? Like, you get 20 billion for 5 billion, right? So anyways, I think that's one part of the competitive dynamics that will be interesting to see in 2026. But it's a market that is somewhat hard to predict, though.
Great. That was very, very insightful, Stefan. Thank you. And in this context, I think that the next obvious question is, you mentioned that 2026 is a year of distribution, but also a key milestone for you in 2026 is this progress into a full banking license with the acquisition of Binio's license, no? So how do you see KLAR evolving in 2026 with the banking license? You mentioned, I listened to previous podcasts from you in the past, that you knew that you needed to regulate. So what was the driver for you to regulate further to obtain a banking license? And in which segments of the market are you most interested to compete? Of course, the payrolls, no? And how do you see the competitive dynamics in each of these in the pockets?
Yeah, absolutely. I think so. We look at it as an enabler of growth, right? I think it is net positive for the probability of attracting payroll, right? Because you can say like, hey, You can participate in the payroll portability scheme that the regulators have implemented. That is a very, like, not very used today, but on paper, it's a very attractive tool, right? So let's see if we digitals can foster the adoptions much more. You get a higher deposit insurance, which is very relevant for those high income decile users, right? And on the SME side, it was also one of the key drivers, right? Remember, we want to put our money where our mouth is into building a multi-sided marketplace, right? Where we serve both SMEs and consumers. And when you go and ask the users on the SME side, deposit insurance matters a lot. Like when you ask on the consumer side, like weirdly, it doesn't matter that much because I think a lot of people don't understand it, right? Or they don't have enough disposable income to be over the thresholds in which it wouldn't be covered, right? But on the SME side, it matters a lot, right? That's where people are not going to risk the liquidity of their company being able to pay payroll because somebody's offering them 200 bips more as a SOFIPO, right? So I think that were some of the key drivers, right? On our hunt in the consumer side for principality, having be a participant of payroll portability, being able to offer slightly better terms on some long-term credit products is also a driver, and we'll announce some stuff there, right? But that was, let's say, an enabler of faster growth or more principality. We don't see it as a step change. On the SME side, we do see it as a step change, right? SMEs want to bank with a bank, right? Like that was a conclusion that we got from our users, and hence we had originally started a process to become a full-fledged bank, right? We have, it's not a very big market, but a lot of people are trying to sell banking licenses for a while because some folks have made good money on those transactions, right? We've been offered every single one. But we always had a clear framework to say like, hey, price needs to be in the right place, right? Because people are trying to get a bit creative with the pricing. It needs to be a model that is similar to what we do, right? Because that matters a lot to the regulator. If you end up buying a regional bank that caters to SMEs through physical branches in the northwest of Mexico, and you want to turn it into a digital consumer bank, I don't think regulators love that, right? I think regulators, like it goes through a process of a lot of operational and regulatory change. And the other piece was, what kind of risk are we buying, right? Because, I mean, diligencing the balance sheets of banks in Mexico, unfortunately, is not the most straightforward thing, particularly if they don't have very sophisticated governance, which often these sellers don't have. And so we found something that the pricing was very coherent, right? Given the nature of the seller. The management of the seller couldn't be more professional, right? You're talking probably about the most professional team in the industry. And it happened to be a bank that was built to do exactly what KLAR does, right? I mean, they stopped it at a much smaller scale, but they built it that way. And because they stopped it at a much smaller scale, they didn't have any risk, right? Like, I mean, it's the cleanest balance sheet you will find of a bank probably in the world, certainly in Mexico, no? So we made that move, right? And now we're in the process of getting through the hoops of getting that authorized, right? But we don't see it in the model, in the financial model, as a step change, right? Where all of a sudden your business is 2x. But we do see it as an enabler of principality. And on the SME side, which will become a more important part of the equation going forward, we do see it as a must-have.
Okay, great, Stefan. And I think that our next question is, in terms of capital, you mentioned at the beginning you're thinking of an IPO. You mentioned this on the media the past year. With this banking license, where do you see capital requirements? Would you be thinking in an IPO? And a frequent question from investors is, would this happen in a dual listing? Are you looking to list abroad? How are the capital requirements once you have the banking license? Because you mentioned also that you're well capitalized, no? Do you need the money? Where are you in terms of these capital requirements?
Yeah, I think the beauty about, I mean, the SOFIPO framework, which is the one we operate under, gets a little bit of slack because it doesn't get a lot of slack because it's a bit of a traditional framework. But one thing that is very smart about it, it has some graduality, right? So if you're a very small SOFIPO, the requirements are nothing. If you're a relatively large SOFIPO such as us, the capital requirements are basically the same as a bank, right? So for us, there isn't an arbitrage of saying like, hey, let me stay as a Sofipo because then I don't need more capital. The moment you become a big Sofipo, it's almost one-to-one in terms of capital requirements as a bank, right? So that is not a big differentiator. The capital that we need is the one that the business requires as it grows, right? And it's aggressive growth, and hence we need the capital. But we have it, right? We have a good amount of cash in the bank. And we have, like, when we think about capital and fundraising and whatnot, I mean, the capacity of players to deploy or of investors to deploy capital has been a key criteria, right? That's why we have folks like General Atlantic on the cap table, folks like Nasper, Prosus now formerly known as Naspers, the IFC. We've always optimized for folks that would have the capacity to continue deploying money as the business grows, because that's efficiently deployed capital, so to say. But now in 2020, well, now 2026, but 2025 was the year of FinCEN, right? Like it wasn't the year of anything else. It was the year of FinCEN. And it was the year of admitting that not just like in a sublime way, but in a very explicit way, Mexican banking financial markets are regulated by the US, which was, I mean, I wouldn't say that publicly, right? But that's a reality.
Yeah.
And so what am I getting to? The quality of the shareholders. No, the beneficial owner, the ultimate beneficial owner of the shareholders becomes almost the most important thing that one needs to be aware of, right? Because in an environment which won't change in the near future, in which you need to be able to tell, forget about CNBV, you need to tell the Treasury of the US who your UBOs are and tell them that these are folks that are clean as a whistle and like there's nothing like, I mean, the governance of those investors or investment vehicles is extremely sophisticated. That's the other criteria that we had optimized for a little bit more as a second criteria, but now we optimize this as a criteria. So for example, we brought in a development bank. I don't think it's public. I mean, the IFC has a meaningful position with KLAR, but development banks come knocking, which before development banks, I mean, they're amazing and they know and they had to get a lot of respect from authorities, but they tend to move a little bit slower because they're relatively bureaucratic institutions. Now we say like, come on board, right? Like we will open up the cap table just to have you on board, because if things hit the fan again, those are the people that you want on your side, right? So deployment, capacity to deploy capital is important. I think we had that covered because we have some of the largest growth investors that have a strong commitment to emerging markets in the region. Now we've complemented it with folks that have the pedigree. No, Santander is a strategic investor of ours, and this time we let them invest a little bit more because it matters when the Treasury come knocking and say like, hey, who's behind this thing? We say like, hey, it's Santander and it's the IFC and it's GA. It's not me. It's not my uncle. It's nobody that I need to fiddle around and tell like more like corporate governance like story. No, so that's the other thing that we're truly optimizing for, more than just do these folks have the ability to deploy capital or not, because luckily we had ticked those boxes relatively early on.
Great. Thank you, Stefan. And I think that maybe a final question for you, Stefan, in the interest of time, is how do you see the regulatory environment in Mexico? We have this proposal of capping interchange fees. How do you see these readings? As you mentioned, the Mexican environment is very different from Brazil. We don't have PICs. We don't have a very progressive regulatory environment for fintechs. So how do you see the challenges on this side?
Yeah, I think after FinCEN and it wasn't very public because a lot of these were informal lenders, right? But I mean, Game, that you're familiar with, a relatively large Sofipo blew up in a very like dramatic fashion. Oh, there's a couple of other Sofipos that have officially blown up or are in the process of blowing up. Préstamo Feliz, no? Like an informal lender that is filling that void that nobody wants to fill from the G7, $500 million loan book blew up, right? So you have, I think the fintechs are starting to hit hard the non-G7 lenders. I think it's a bit of a hidden effect that is happening here, Because if you get a purple credit card instead of a loan in which a guy comes with a baseball bat to collect every 15 days, no, and they charge 1,000% versus 100% on the purple card, take the purple card, right? I think that's the no-brainer. And you start to see that is a hidden effect that doesn't get talked about a lot because a lot of these figures are not regulated. But the regulator knows, and the regulator is like, oh, I start to have a problem in the performance of non-well-financed fintechs, okay? Now, you have that effect that is very top of mind all the way to Amador, no, to the Treasury Department, to the Treasury Secretary, and you have FinCEN, right? And I mean, let's see how these things play out over the next couple of months, right? But FinCEN is the new de facto regulator, right? In which there seems to be a very clear instruction from Amador all the way down to it, like, don't cause any problems, right? Like the G7 works. Some of the fintechs seem to be doing fine. Please don't bring me problems, right? So this is a very long-winded way to say the posture of the regulators in Mexico is 100% risk off. 100%. It couldn't be further risk off, right? So what does it mean? Very little new movements in terms of who is there, who's not. Who for us, probably it's better than not, right? Because like there's not going to be a lot of movement of new entrants. The licenses that are in play, including our BNA acquisition, we need to be more patient, right? Because I think the regulator is a bit like, hey, let me take a more thorough look. And I think it's very much justified. Let me understand ultimate UBOs, no? Ultimate beneficial owners of everything that is in the ecosystem, right? Because there's a lot of stories that aren't very coherent, right? And the investors hear something and the authorities hear something, right? So I think they're going to spend some time figuring that out. And that's a little bit on who is playing, right? I think that's a little completely risk off. Let's take it a little bit slower. Now, in terms of priorities, again, the interchange cap that is being discussed, it won't be as aggressive, as my personal opinion, as originally laid out, but it will happen.
Oh, okay.
Right? It will happen, right? I mean, you never like to see a chunk of your gross margin go away, but it is coming hand in hand with a more holistic conversation about financial inclusion and digitization. So I agree that we haven't had our PIX moment, and I've never said we will have our PIX moment in the past 5 years. Now I might say that, right? It's like maybe we do have our PIX moment, right? Because what we are doing as financial institutions is like, okay, let me take a hit on the interchange, but help me get the 40, 50 million Mexican adults that are not in the financial system into the system, right? Because these are folks that are paying with cash, and KLAR, Nubank, like we're phenomenally well positioned to underwrite them, right? So it's like if we lose a little bit here, but the addressable market grows by even if it's at 1.3x, whatever. I mean, that's a deal we're willing to take, right? And that goes hand in hand with the needs of the government to increase fiscalization, which you see across all sectors, right? So I think there will be a bit of a PIX moment happening, right? And I think there will be more adults that we can underwrite if we underwrite them or if we operate the business with a slightly lower or even materially lower interchange, which everything is on the table, it will gonna be fine, right? I think it's the complacent incumbent institutions that have had their meal served every evening at 7 p.m. for the last 100 years, no? I think they have a bit of more trouble adjusting to changing dynamics. No? So I'm relatively bullish. So what I'm trying to say is completely risk off in terms of players. Very, I don't know if aggressive is the word, but very proactive in initiatives that before they didn't take that seriously, like the CODI, the DEMO, no? It's like kind of like, yeah, please do it, but not now. It's like, let's do it or let's do it.
How do you see this PIX movement? So is there any further improvement to CODI and DEMO? Is this really happening fast payments in Mexico or what do you have on mind?
No, I mean, the weird thing, and I mean, I'm not a payments expert, right? But I spend a lot of time thinking about these things, right? It's that from a technology point of view, CODI, like SPAY, whatever you call whatever is on top of it, is as good as PIX, which is the big check mark, right? Because if you're trying to implement a PIX in the US, it's going to take you 10 years because the ACH doesn't work at the speed at which SPAY works, right? So technology point of view, it is there. Now, the reality is that the incumbent players don't want to do these things because they don't make any money off of these things, right? And they're going to lose their like super coveted interchange. So you have two things that have changed there. All of a sudden, there's enough scale on the digital side where maybe the Brazilians and the Russians and the Mexicans and the Chinese say like, hey, we're willing to do it, right? Because nothing is better, like everything is better than the status quo, right? So let's adopt it. And all of a sudden, maybe there's 15 million accounts, and maybe that's critical and mass to tip the scale. No, so that has changed. And the other thing that has changed is that with this conversation, and I cannot disclose too much, but about the cap on interchange, a lot, even the folks that were very reluctant to give into CODI, etc., they're saying, okay, don't decrease them that much, but let me foster the adoption of CODI and let's do it for real, right? Because realistically, those folks 5 years ago and 2 years ago, and whenever they ask them, they're like, yeah, whatever. And then it got like put in the gaveta, no, in the drawer. And now it's like, okay, don't decrease that hard and I'll help you. And so what some of us are pushing is like, hey, let's tie those, right? It's like, I mean, I don't think we'll end up there, but what would be my dream is like, hey, if adoption of PIX goes up by X%, then only decrease the rates by X%, right? And if nobody does anything about PIX, or sorry, about CODI, then hit us super hard, as you said initially. Because then you need to keep a bit of the carrot and the stick. I think it's maybe too complex for the authorities to operationalize, but that's where I think things should go. And implicitly, they would go there, no? Because all of a sudden, folks that are now admitting that they didn't do anything about CODI and DEMO are now like, let me show you that it can work, right? It's all a matter of incentives, right? There needs to be enough fear put into the financial institutions that if you don't do it, it's going to have negative repercussions. And the other thing is, there needs to be enough margin somewhere, right? Where it's like, if somebody can make a little bit of money on that thing, people will jump on it in an efficient market, right? And I think the markets tend to be somewhat efficient, even in these oligopolies. So I'm carefully bullish that it will happen.
Great. Thanks for that feedback, Stefan. And that really was very useful. So just to wrap up, Stefan, KLAR, I think you have enough capital, multi-line, going for a banking license, new segments. Any closing remarks? How do you see KLAR in the next 5 years and the industry as a whole? Just as a closing remark, Stefan.
No, I mean, we aim to continue growing 50 to 80% year over year, right? Which will put us in that coveted $600-700 million ARR threshold, maybe 15 months from now, right? Which is probably where we can very seriously start considering an exit in public markets. Probably a dual listing is what makes most sense, but we're still in early stages of exploration. So that's where we're gunning, right? I think on the business side, what I want to see is less dependency on a segment that is somewhat commoditized, right? That is these like medium class credit cards. I want to see more on the affluent side. I want to see more on the SME side. I want to start to see some virtuous cycle between segments. I want to see the distribution, the proprietary distribution deliver results, no? Maybe in the form of partnerships, maybe in the form of co-brands. So that's where my mind is at. But the business, I'm confident, will continue compounding at a needed scale to position us as an IPO candidate, having the most robust cap table, the most robust corporate governance. Like, I think being a local player that is funded by internationals will play in our favor, as well as we look at this like eternal like governance question. So we're very bullish. We're very bullish on it, and we don't see any signs of saturation, despite there being like fairly aggressive competitive dynamics, other than when you try to marginally acquire like 20% more credit cards per month. We've always believed in unit economics. We've always believed that the pref stack matters, right? No, in order to give our investors a good return on their money. So we're bullish. Honestly, we're very happy about where the business is and pretty bullish about where it's headed.
Awesome. Great to hear that, Stefan. So with this, thank you very much for your time. It has been very interesting to follow KLAR's story, and hopefully we can talk further in the future. Thanks a lot for your time, and thanks a lot for all the participants in this webinar. It has been a very useful conversation.
Thank you very much, everyone, and thank you, GBM, for hosting this.
Thank you very much.
Thank you. Have a great day, everybody. Bye.